In 2008, while millions of people watched their retirement accounts lose half their value almost overnight, there was a quiet group of investors who barely felt it. They didn't short the market. They didn't predict the crash. They weren't geniuses. They just owned something that most people ignore completely and have been ignoring their entire financial lives. And here's what makes this interesting. That same thing that protected them in 2008. It's also the thing that governments use to fund wars. That corporations use to raise billions without giving up any ownership. That Warren Buffett, one of the greatest stock investors who ever lived, keeps hundreds of billions of dollars in, even though he could put it anywhere he wants. It's called a bond. And there's a good chance nobody has ever properly explained it to you. By the end of this video, that changes. Because once you understand how bonds actually work, not the textbook version, the real version, you'll understand something about money that most people never figure out. And you'll understand exactly what those quiet investors in 2008 knew that everyone else didn't. Stick around, because there's something in the middle of this video that completely flips the way most people think about risk. And once you see it, you can't unsee it. Here's something worth admitting up front. Most people, when they hear the word bond, feel a specific kind of drowsiness settle in. Like when someone starts explaining the rules of cricket at a dinner party. Technically important, but somehow immediately forgettable. So they skip it. They focus on stocks. They read about index funds. They watch videos about crypto and real estate and passive income. And somewhere in the back of their mind, bonds stay in this vague category of something I'll understand later. Later never comes. And the problem with that is significant. Because bonds aren't a side topic in personal finance. They aren't the boring footnote at the bottom of the page. They are, in terms of total market size, actually larger than the global stock market. Let that land for a second. The thing most people have never properly looked at is bigger than the thing everyone talks about constantly. The global bond market is worth over $130 trillion. The global stock market, roughly $100 trillion. Bonds win. By a lot. And here's the part that makes this even more striking. The people who understand bonds best, the ones managing the largest pools of money on the planet, almost never put everything into stocks. Even when they could. Even when they can afford more risk than anyone. Why? That answer is coming. And it will change how you think about what smart money actually does. But first, let's learn the basics properly. Starting with a story about someone you're going to want to root for. Sarah grew up watching her mother bake. Every Saturday morning, the smell of cinnamon rolls and fresh bread filled their apartment. Her mother baked for neighbors. For church fundraisers. For anyone who asked. She never made much money from it. But she never stopped either. When Sarah turned 34, she opened a small bakery of her own. Named it after her mother. Worked 18-hour days for the first 2 years. Lost sleep. Lost some weekends. Gained a few loyal regulars who became something closer to family. By year 3, the bakery was genuinely doing well. A second location felt possible. Felt right. The equipment alone would cost $50,000. She didn't want to bring in investors and give up ownership of something she built from scratch. The bank loan terms weren't great. So she came to you. She sat across from you at her own bakery counter, the one she built, and she said, "Lend me $50,000. I'll pay you back in 5 years. Every year in between, I'll pay you 6% interest. That's $3,000 a year just for lending the money. Then at the end of 5 years, you get every dollar back." You think about it. You've watched what Sarah built. You've seen how she operates. The terms are clear. The timeline is defined. The risk feels manageable. You shake hands. What just happened? You bought a bond. That's the whole concept. A bond is a loan, where you are the lender. The borrower could be a friend, a company, or a government. They need money now. You provide it. They promise to pay you interest regularly, called a coupon payment. And at the end of an agreed period, called a maturity date, they return your original amount. Simple. clean, defined, and unlike most loans, bonds can be bought and sold after the fact. Which is where the story gets a lot more interesting. Let's go back to Sarah's bond. You're holding it, collecting your $3,000 a year. Life is good. But 6 months later, interest rates in the broader economy go up. Banks are now offering 9% on savings accounts. New bonds being issued are paying 9%. Suddenly your Sarah bond, paying 6%, looks a lot less attractive. Nobody would pay full price for it when they could get a brand new bond paying 9% instead. So if you wanted to sell your bond, you'd have to drop the price. Accept less than $50,000 for it, to make the effective return attractive enough for someone else to buy. This is the relationship that confuses almost everyone. But once you see it, it becomes obvious. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. They move in opposite directions. Always. Like a seesaw. Here's why this matters beyond your own portfolio. When central banks around the world want to understand what's really happening in an economy, they don't look at the stock market first. They look at the bond market. Because bond prices reflect what millions of the world's most sophisticated investors actually believe about the future of interest rates, inflation, and economic growth. Stocks can be driven by emotion, hype, and momentum. The bond market, at the scale it operates, is harder to manipulate. It tends to reflect reality more honestly, which is why, during major financial crises, governments and central banks intervene in the bond market before they intervene anywhere else. Because stabilizing bonds stabilizes everything downstream from it. Now you understand something most people watching the financial news will never piece together on their own. And that understanding, quiet as it is, gives you a kind of confidence that no headline can shake. Here's where most people's understanding of bonds goes wrong. The common assumption is, bonds are safe, stocks are risky. Young people own stocks. Old people own bonds. Simple. That framing isn't completely wrong. But it misses something that has cost real people real money. Bonds are not simply safe. They have their own kind of risk. And in 2022, when interest rates rose sharply to fight inflation, the bond market had one of its worst years in modern history. People who thought they were in the safe investment watched values drop 15 to 20%. The honest picture is this. Every place you put money carries some kind of risk. Stocks carry market risk. Bonds carry interest rate risk. Cash sitting in a savings account loses value quietly to inflation every year. There is no perfectly safe option. There are only different types of risk, and the goal is to understand them well enough to balance them deliberately. Which brings us to the insight I promised you at the start. The one that explains why Warren Buffett, a man who built his entire fortune picking stocks, keeps hundreds of billions in government bonds. And why, once you understand the reason, it makes complete sense. Here's what most people never understand about why serious investors hold bonds. It has nothing to do with playing it safe. It's about what bonds do during the exact moments when everything else falls apart. Think back to 2008. Stock markets around the world lost 40, 50, even 60% of their value within months. Panic everywhere. People selling everything. During that same period, high-quality government bonds went up in value. Not slightly. Meaningfully. Because when panic spreads through markets, investors rush toward certainty. Toward guaranteed payments. Toward the defined, predictable nature of a bond. And that rush of demand pushes bond prices higher at the exact moment stock prices are collapsing. This is called negative correlation. And once you understand it, everything changes. It means that in a properly built portfolio, when one thing falls, the other tends to rise. The overall damage to your total wealth is significantly reduced. You don't have to sell your stocks at the worst possible moment to cover your expenses. You can stay invested during the crash and capture the full recovery that follows. Most people experience market crashes as emergencies. Something to survive. Something that keeps them up at night wondering if everything they saved is disappearing. The people who understood this relationship experience the same crashes differently. Not without concern, but without panic. Because their portfolio was built to absorb the shock instead of collapse under it. Now here's the part that answers the Warren Buffett question. Buffett doesn't hold Treasury bills because he's playing it safe. He holds them because they give him optionality. When markets crash and everyone else is panicking and selling, he has liquid, stable capital ready to deploy. He can buy quality stocks at crash prices, while everyone else is frozen. The bonds aren't the defensive move. They're the ammunition. That's what the quiet investors in 2008 understood. Bonds aren't the opposite of opportunity. In the right moment, they are the opportunity. Think of bonds like lending money to different types of people in your life, and the interest rate reflects how confident you are that you'll get paid back. Lending to the U.S. government is like lending to the most reliable person you know. The one who has never missed a payment in their life. Has a stable job. Has been around for 250 years. You're not getting rich lending to them, but you're sleeping well at night. These are Treasury bonds. Low interest. Extremely high reliability. And here's something most people don't realize about Treasury bonds specifically. They are considered the closest thing to a risk-free investment that exists anywhere on Earth. When financial institutions around the world need to park money in something that will absolutely still be there tomorrow, they buy U.S. Treasuries. Not because America is perfect. Because at a global scale, there is no better established creditor in history. Lending to a large established company is like lending to a successful friend with a great track record. Slightly more risk. Noticeably higher interest in return. These are investment-grade corporate bonds. And then, there are high-yield bonds, sometimes called junk bonds. These are like lending to your entrepreneurial cousin with 3 businesses, 2 of which worked out. Potentially great return. Genuinely higher chance of things going sideways. They behave more like stocks than bonds. Which limits how useful they are as a balancing tool. For most ordinary people, the first 2 categories are the relevant ones. Government bonds for stability and optionality. High-quality corporate bonds for slightly better returns with manageable risk. You don't need to become a bond trader to benefit from understanding this. You just need to know what you own, and why. Here's where this becomes practical for someone who isn't managing billions. The most common way ordinary investors access bonds is through bond index funds. Instead of buying a single bond from one borrower, a bond index fund holds thousands simultaneously. Different governments. Different companies. Different maturity dates. One company defaulting barely registers against the whole. What tends to work for people building long-term portfolios is holding both a stock index fund and a bond index fund, in proportions that reflect where they are in life. Someone in their 20s and 30s, with decades before they need the money, can afford to hold more stocks and fewer bonds. Time is their buffer. If markets drop, they have years for recovery before they need to withdraw anything. Someone in their 50s and 60s, approaching the point where they'll actually use the money, benefits from more bonds. Not because they're giving up on growth, but because a 40% market drop right before retirement, with no bonds to cushion it, can mean working several more years than planned. It can mean the retirement you spent decades building getting pushed further away at the moment it should finally be arriving. Here's what's counterintuitive about this that most people miss. Adding bonds to a portfolio doesn't just reduce risk. Research consistently shows that a portfolio with some bonds, say 20 to 30%, often produces better risk-adjusted returns over time than a portfolio of 100% stocks. Not because bonds earn more. Because they reduce the panic selling that destroys returns during crashes. The steadier the portfolio feels, the more likely an investor is to stay invested. And staying invested is where the real returns actually come from. The goal isn't to eliminate risk. It's to make sure the risk you carry matches the timeline you actually have, and the life you're actually building toward. Let me tell you about someone. She's 58 years old. Spent her career as a high school teacher. Never made a dramatic salary. Never had access to fancy investment products or a financial advisor on speed dial. In her 30s, She started contributing to a simple target date retirement fund through her school's plan. She didn't fully understand everything inside it, but she contributed automatically every month, and she left it alone. What she didn't know at the time was that inside that fund, the managers were automatically adjusting the ratio of stocks to bonds as she got older. In her 30s, mostly stocks. In her 50s, a meaningful portion in bonds. In 2008, when colleagues who held only stocks watched their portfolios cut nearly in half, her portfolio dropped, but significantly less. And because the damage was survivable, she didn't panic. She kept contributing. She went home that year, had dinner with her family, slept. While others were making desperate decisions based on fear, she had nothing to fear. Not because she was wealthier, because her portfolio was built to survive the exact moment everyone else was crumbling under. By retirement, her portfolio had recovered and grown far beyond where it was before the crisis. Not because she was sophisticated, because she had, without fully realizing it, owned bonds alongside stocks. And that mix did exactly what it was designed to do during exactly the moment it needed to. She didn't understand bonds at 30, but she benefited from them anyway. Imagine what happens when you understand them on purpose. Remember the investors from the beginning of this video? The ones who barely felt 2008 while everyone around them was watching decades of savings disappear in months. They weren't in a secret club. They didn't have access to special investments. They weren't smarter or luckier or more connected. They just understood one thing that most people skip past. When stocks fall, truly high-quality bonds tend to rise. And a portfolio built with both can survive the exact moments that destroy portfolios built with only one. Not just survive, but emerge with dry powder ready to buy when everything is on sale. That's what Buffett understood. That's what the largest funds in the world understand. That's what the quiet investors in 2008 understood. And now, you understand it too. Not in a textbook way. In a real way. You understand why bond prices move. Why they behave differently from stocks during market panic. Why the bond market is actually larger than the stock market. And why central banks go there first during crises. Why even the world's greatest stock investor keeps hundreds of billions in government bonds. And how ordinary people can use this same logic to build portfolios that hold up when everything is falling apart. Here's what we covered. A bond is a loan where you are the lender. Bond prices and interest rates move in opposite directions, always. Different bonds carry different risk levels, like lending to different people in your life. Bonds aren't just a defensive tool, they're optionality, ammunition, and balance all at once. And in a properly built portfolio, they protect everything else you build during the exact moments when protection matters most. Most people will spend their entire lives reacting to financial news with anxiety. Not knowing why markets move the way they do, not knowing what the signals mean, not knowing whether to panic or stay calm. You don't have to be one of those people anymore. The investors who slept well during 2008 didn't have better luck. They had better understanding. And understanding, real understanding, is the one financial advantage that never expires, never crashes, and never gets taken away. Now you have it. If this helped, subscribe. I put out honest, straightforward breakdowns like this every week. And if someone you know has been confused about why their portfolio swings so dramatically, or why financial news feels impossible to follow, send this to them. Sometimes, the most valuable thing you can give someone isn't money. It's the knowledge that removes the fear around it. See you in the next one.